Hey guys, how are you doing? I hope that you're having a fantastic Saturday so far. It has been a while since I've actually been able to come out and talk with you guys on the Saturday, so I'm excited to get going today. Today, we're going to be talking about financing and how real estate investors use financing to help supplement their business plan. I've seen a lot of different ways that financing has been used, and I've actually used a lot of them myself. And so I think the first thing that you can do in order to understand and appreciate how powerful this concept is to talk about the terms. And as we start talking about the terms, you're going to realize that sometimes the lending and the financing will make or break the deal. And actually, that has been more the case in the last year or so than I've ever seen before. A quarter of a percent of an interest rate change could completely destroy a deal. So it's very cool to be able to talk about all these things with you because you can usually pick the right product out. And if you know what questions to ask, then you can get the right tool to get the job done for you. So, first, let's talk about some terms real quick. First is interest rate. And basically, that just means the interest rate or the rate at which you're going to be repaying the money that you are borrowing. Then there's balloon. What balloon means is, let's say that you have a product or a loan product that has a term of 5 years, but they're not expecting you to pay it off. They're calculating the payments based on a 20-year payment period, but you're supposed to pay it off in 5 years because after 5 years, they're like, we don't want to have this product anymore. So they'll pretend that you're going to pay it over 20, but then in 5 years, the whole thing is done. So that's a balloon. And then amortizations, that kind of feeds into what we were talking about before. Amortization means how quickly are you going to repay the loan with interest at the interest rate set? So for like a 30-year loan, that means that the payments are much lower than if it was a 10-year loan, because if you pay it back in 10 years, then you're paying a lot of principal and a lot of interest, well, a lot of principal right up front. And so that compresses the payback period, which makes the payments higher. And of course, when you have a longer payback period, it's lower payments because they're longer. And then non-recourse, that's another interesting term. Non-recourse means that instead of the bank coming after you personally, all they have control over technically is the entity or the corporation that owns the property, right? And so non-recourse is a really important thing, and things that we look for as real estate investors to be able to use in terms of debt, so that we're protecting ourselves and our own personal assets and our other assets from any type of loss in one specific asset class, okay? And then prepayment penalty, and it's another thing that we have to talk about. It just means that as you're paying back the loan, sometimes paying it back faster, sometimes loan folks don't like that in the financial industry, because they were expecting a certain amount of revenue or interest off of the loan that they lent you, and so you'll have to pay a penalty to pay it back early, which is weird. And so some of you guys may also have experience with that too, depending on the loans that you have with your house. And then, of course, IO is just the interest only. And usually what that means is an interest only period at the beginning of the loan. Whenever I do like a bridge loan or something we'll talk about pretty soon here in just a second, I like to take out a small interest only period so that you can do the construction real quick and use all of the cash flow to pay for rehabs instead of paying for interest at the bank, or principal, I should say, at the bank. Okay. So those are some financing terms. Now let's talk about different types of financing. The first is hard money. I don't know if many of you have heard about what this is, and it sounds a lot like how it actually is. What it is basically some lender that has a high risk tolerance is able to come to you and say, hey, I will lend you 90% or even sometimes 100% of the purchase price of this property, and I'll also give you money to rehab it. The catch is that you've got to pay me points, which is cash basically to originate the loan. And then the loan is very high interest, like 12, 13, 14%. And in this era right now, where you can get a loan for anywhere between 3 and 4% from a longer term lender, that is very much a premium, but you're paying for that in terms of flexibility and what you can do with the hard money. So oftentimes they only last about a year. So they have really high risk, high rates, and high returns. Okay. All right, so that's hard money. Next is a bridge loan. A bridge loan often has middle to high rates. These days, it's actually much lower than it used to be. And usually they have huge balloons. These bridge loans are usually meant to last for maybe 1 to 3. And I would say it's kind of a mix of a product between a hard money loan and a residential loan or a longer term loan. And you use this to kind of bridge the gap between getting construction done and finishing a value add. So you have a lender that's really flexible. You're paying a high interest rate, and they're saying, okay, you just pay us a lot of money in interest. You can have more freedom to do what you want to do. And then you'll have a really big balloon after 3 or 5 years. They expect the loan to get paid off or refinanced out so that the lender gets paid and made whole. And sometimes a bridge loan often includes CapEx. So they'll use loan to cost, which means that they'll take basically all of the acquisition costs. They'll take the purchase price, the closing costs, and even the construction costs, and they'll roll it all in and lend to you against that. They'll say 75% of everything instead of just saying 75% of just the purchase price, and then you have to pay for your own CapEx and also the closing costs. So those are things that bridge loans and bridge lenders and local banks will do for you, okay? Next is pretty simple. It's a residential loan with Fannie Mae. And these loans are 30 years long. It's oftentimes what people have on their own private residence, and they're very attractive in terms of rates for new purchases. On rental properties, it's 25% down and still have a 30-year amortization. They will no way include CapEx. They won't let you borrow any money to do construction on the property. That will have to do a separate product for that. It's usually on purchase price only, and it is not assumable. Okay, so that's what a residential loan is. And by assumable, I mean that someone else who comes by and wants to buy the property from you most likely will not be able to inherit your loan unless you do some sort of lease option, or you do some sort of mortgage wrap or something like that that's a little bit more sophisticated than I would be able to comment on. I do have some friends who have the ability to do that and can speak to that as well. So I can talk about that more if there's interest there. All right. Next is commercial loans. And there's two types of commercial loans. There's agency loans, which is what we're going to talk about right now on commercial side. And what that is it's a non-recourse, really low rate, 20 to 30% down, 30-year amortization loan. So you can think of it as the residential loan or a long-term loan for commercial property, for apartment buildings, okay? It's usually assumable, which is great because if you have like a 10-year term on that thing, even though it's a 30-year amortization, they're only going to give you 10 years to be able to make payments on it and keep that loan. And at the end of 10 years, most likely they'll end up wanting you to refinance or pay it off, okay? Or somehow sell the property, just close the loan out, okay? And there are a lot of things you can do with these types of agency loans, at least with where I'm thinking about is mostly Freddie. Freddie Mac will allow you to select what type of prepayment penalty you want, because there's different types of prepayment penalties, which I'm not going to get into. There's interest-only options for like 24 months or 12 months. You can price all that in, and then basically they change the rate. So the rate gets a little bit higher if you're going to add extra options in. And there's a 5, 7, and 10-year term option as well, and those all affect the rates. So depending on what your business plan is, you might want to go for a 7-year or a 10-year. Most of the people that I'm talking to right now want 10 years because they're pretty sure the interest rates are going to be hiking up in the next year or so. And so we want to get ourselves into nice long-term debt so that we'll be all prepared on the other end of it. Okay. And it's assumable. So the next person who comes along to want to buy the property can just pick up the loan where it's at right now. So let's say there's 3 years or 7 years left on the loan. They'll just take over the remaining 7 years and then pay the difference in purchase price to me, so that when I'm sold the property, I get that extra income, and then they can assume the loan that I've already generated in the past with the really low rates. Okay, so that's the agency loans. Then there's commercial loans on the same type of asset with local banks. And this is a little bit different than agency loans. They're usually recourse, which means that these lenders will go after you personally. They'll make you personally sign for it because they don't want to have non-recourse. They just are more comfortable having someone sign for all of them. They're lower rates, 20 to 30% down, and usually they have more flexible terms, and sometimes they can even do 100% of CapEx expenditures and loan to cost type structures. They do interest only as well, but usually they only max out at 25-year AM. They don't go up to 30. That's only a Freddie thing. And again, the term is usually 5 to 10 years, so they don't like to have these things hanging out for a really long time. And then sometimes they have prepayment penalties, but the cool thing about local banks is that you can really negotiate with them a little bit. Okay, so like if you have a product that you're looking for, or there's something that maybe doesn't work, or you want to tweak it a little bit, banks can negotiate with you, especially if you have a really good loan broker. They'll be able to help you work through a lot of this because they have other contacts and they have good experience in how to make things work and how to make you comfortable and how to make the bank comfortable to fit into the business plan. Okay. And then that's basically it. Those are the major mortgage types, but I've also heard of and seen HUD loans done before and portfolio loans. HUD loans are like 40-year amortization products, but there's huge amounts of paperwork involved to get there. And oftentimes you can't do it with a new purchase because it just takes 6 months for the loan to clear. So unless you have a very, very patient seller and you as a buyer want to go in with a HUD loan, it's going to be very hard to be able to do that because the closing time frame is going to be huge. So usually you'll get in with a bridge, right? You'll get in real quick with a bridge loan. And then while you own the property, you just get the paperwork prepared and get your HUD paperwork ready. And then you get that all squared away. And then there's portfolio loans, which is something that I've seen before with a lot of people, and including myself, is that you have like a series of properties or, single families and multifamilies. And then you find a bank to just say, all right, how much equity do you have in all these properties? We will be your lender. So we'll refinance out all of the current loans you have. And then if there's extra equity, we'll give you that money out, or we'll just pay it out, or it can be a line of credit. So there's a lot of things that you can do creatively if you have a bunch of assets in real estate and the bank wants to lend to you and help. They want to make an interest, they want to make a return, but they also want to make sure it's secure. So they can get really creative with what you want to do there. So I hope that was useful. I know that it was probably a lot of jargon, but if you guys got any value from this, I'm here. And you can always listen to this again on the YouTube channel. So if you like what you heard or want to hear more like this, please like, subscribe, and comment, and just let me know how I did. And hopefully this was valuable content for you. And also in the link, there's a link in the description, and click that to find out the 7 ways that commercial real estate helps preserve, protect, and grow your wealth as you go through your journey of building wealth for yourself and for your family. Okay. So I think that's everything. So thank you so much for listening. I'm glad to see you guys on here, and have a fantastic weekend. We will see you around soon. And yes, enjoy.